The last time the Bank of Canada announced a 0.25% increase in the overnight lending rate was on January 25th, 2003, and it's been sitting at 4.5% ever since, with no movement on March 8th, which was the last announcement. The interest rate hikes from the last year were a response to the rising inflation rate, which has been hovering above the central bank targets of 2%, well above. While some economists believe that the Bank of Canada has peaked interest rates, TD economists forecast that the central bank will start reducing its overnight rate towards the end of 2023, with the rate reaching about 2% by 2025. The increase in interest rates have an effect on the mortgage prime rate, which is what is used to determine the interest rate charged on variable rate mortgages as well as other types of loans. Those with fixed rate mortgages are protected from the interest rate changes until obviously their mortgage is up for renewal and they have to look at the new variable and fixed rates. Those with variable fixed rate mortgages have been experiencing the fluctuations in their interest rates and mortgage payments as they've gone up, unfortunately. The recent inflation data shows that inflation has moderated, coming in lower than expected at about 5.2% year over year in February. However, inflation remains above the bank's targets and inflationary pressures remain broad and likely sticky. Some analysts believe that the Bank of Canada will continue to keep interest rates unchanged, while others argue that the core price pressures are still too strong and we still need to make some modifications and increases to the interest rates to keep the inflation down. Despite the current monetary policy tightening cycle ending for now, high inflation and rising interest rates are expected to take their toll on spending and hiring in 2023 and 2024. TD economists also expect that unemployment rate will rise over the coming months as slower economic growth weighs on companies and likely causes job cuts. Household debt payments are also likely to rise to record levels by the second half of this year, which will compound with a sharp pullback in household net wealth as housing markets continue to adjust and retrench. It's a very interesting time because some of these interest rate hikes are having a little bit of a lag to really see the impact. And while global growth forecasts for 2023 have been revised higher due to China emerging from the pandemic lockdown and economic growth in Europe firmer than expected, the global manufacturing outlook has softened and consumer demand and hiring is still expected to experience softness later in 2023. Interest rates impact the economy with substantial lags and delays, and higher interest rates will continue to cut into household purchasing power with a lag. So we may not necessarily be seeing the full impact that the interest rate hikes have had as of yet. In conclusion, though, we should not expect rates to immediately start going down, even though the current monetary policy tightening cycle has ended. The upcoming recession expected is still on a mild side of historical downturns, but will most likely experience a bumpy landing before the economy is entirely back to normal. Recent inflation data has been encouraging, but consumer demand probably needs to soften for inflation to return fully to central bank target rates. As of now, we are not expecting any adjustments to the lending rate on the next announcement, which will be made on March 12th, but nobody will know until that day comes. And overall, I think you gotta look at everything from a balanced perspective, and I think we're in a balanced market right now where we've had a lot of impact on the housing market with the interest rate hikes, and you've seen the price and demand come down over the last year, and now with the pauses and a little bit more of a positive sentiment in the market. What we're seeing that's having a positive impact also on the market, because now there's a lot of buyers still in the market and there's not a lot of inventory. So in a lot of cases, we're seeing some of those multiple offer situations come back, and that's driving prices up. But at the same time, not really fall. It's important not to fall for that because it's a very dangerous time right now to be buying in multiple offers because we have high interest rates. There's a lot of volatility, and it's a different playing field than it was last year where the interest rates were really low. So I'd be really careful if you're a buyer looking to buy in this market and you're going into a multiple offer situation. Just make sure you stay within the confinements of your budget and what your capabilities are financially. I think it's really an important time to be very frugal with your finances and still understand that the impact of these interest rate hikes hasn't fully hasn't fully had the toll on households as of yet, because there's that lag that's going to happen where, you know, we're going to see with the fixed rate mortgages coming up for renewal, that's going to have a big impact on household, and then also just seeing how this plays out over time is going to have a different impact than it has just in the short last 6 to 12 months. So very interesting time right now that's happening with all the changes. I hope that the information in this video was useful to you and gave you a little bit of insight. Overall, very balanced market. It's a very good time to buy in terms of trying to find good opportunities, but at the same time, we are sort of in this period where there's very low inventory, and we're probably going to see a lot more inventory come to the market in the near future. But as of right now, very low inventory, so might be a good time if you're looking to make a transition to sell as well. Hopefully this video was useful and you got some great information. Take care.